as far as this topic is concerned. Till now, we have covered a tremendous amount of coverage as far as the content is concerned. In the last 3 sessions, almost 9 hours spent on forwards, futures, as well as the options. In the last class, we have already completed from the assignment, I think till question number 7. Yeah, question number 7. So today we will be starting with where we left in our last session and try to cover up this chapter as much as we can, because it's a very large chapter. It's a very big chapter. You have a lot of questions in your study material as well as in your practice manual. So it will be good to go that if we are in a situation to complete that as far as the examinations are concerned, right? So shall we just give a quick 2 minutes recap as to what we have done till date in the last 3 classes, and going forward, we'll do one question that will revise the last concept of options, and then we'll continue with the other valuations models. Okay, clear? Okay, good to see you, Sumit and Lakshmi. I hope you guys are doing fine. So derivatives as a chapter has 4 content. One is forward. Second is your future. Option. And one you have interest rate derivative as well. Okay, so don't get a little astonished that why we are not completing this in this chapter. We will be completing this in the forthgoing chapter after you complete your forex. Okay, so till here we have already completed, which is the call option and a put option. As a call option, it is signified as CE and put option as PE. Okay, guys. So we have covered till here. This concept I'll be covering up post forex when you'll complete your forex chapter. And today we'll be completing the valuation model, which are extremely important and extremely complex as well. I will try to explain you in a as easy manner as I can. And before we wind up the chapter, and you also know that in the last paper, means in the November exam, a very conceptual question came as far as the Black-Scholes model. Okay, I'll write over here. So you need to be very particular as to how the things has to be panned out. So we'll be covering up today 3 models. One is called as your binomial, risk neutral, and BSM, Black-Scholes model. Okay, so we'll be covering up all these concepts today for sure. Then I will leave it to your practice that how you want to proceed them further. Okay, so I hope you still remember what we studied in forwards. Then second class, what we studied in future. Then the last class means which held on, I think, last Thursday about the options. So today we'll be covering up the same concept, and you have to be a good champion in option so that you are able to cover up these 2 concepts as well, which is called as your binomial as well as the risk neutral. Because calculating a call option is something you need to be covering up. So what does basically valuation model means is the options that we calculate here, you have to do the valuation of these call option or put option in the examination. So questions are generally very complex when it comes to exam, but if your conceptual clarity is clear, then you will get full marks. You will not have any deduction. Okay, so that is what my effort will be for today. So we can do that. So before we start, I hope there is no doubt we can do something which can review what we covered in the last session before we wind it up. So I'm sharing you a practice manual, excellent question with you. Yeah. Okay, so you can read this. This is from the practice manual. This will give you the, let's say, revision of the last class. Okay, so I'll read it quickly because the question is very simple. Okay, Mr. X established the following spread on a Delta Corporation stock. So, this is a practice manual question, but coincidentally, there's a company as well called as the Delta Corp, which are into the casinos. but again, it's just an arbitrary kind of a question. Purchased 3 months call option and paid a premium of 30 rupees, and the exercise price was 550 rupees. Currently, it is trading at what price? It is currently trading at 500. Okay, so you have bought a call option for 550 beta for 3 months, and you have bought a put option for, again, the price is the time is same, which is 3 months, but now the exercise price is 450. So please be sure in the exam that you know what is an exercise price oblique strike price. So don't get confused in the examination. You have to make your practice very, very appropriate so that you don't do any mistake in the exam. What questions which are given the practice manual which might not come in the exam in the similar way. So it might twist the thing. So you have to very conceptually sound, as I told you, beta. That one is called as the market price, the price at which the stock is trading, and then followed by, you see what is the exercise price oblique the strike price. If you are buying a call and the stock price moves up, then you will exercise the call option and let the put option expire. And on the contrary, if the stock price falls down, then call becomes worthless, and then you have a put option to be exercised. Okay, clear? So you need to determine the profit and loss if the price of the delta corp is 3 situations where you have to calculate: remains at 500, falls to 350, and rises to 600. Assume that the option size of delta corp share is 100 shares. Clear, everyone? I hope you have read this question, and I can start doing it. Okay, I hope you have read this question, students. Okay, now please focus on this. This is a conceptual clarity before we start the question. Okay, so basically, beta, as I told you in the last class, there are 2 kinds of an option. One is called as your call option. One is called as your put option. Okay, simply you have to learn that if you means you as an individual buying a call option, then what is your mind psychology? आप क्या सोचो, stock price बढ़ेगा या गिरेगा? That is the first thing that you need to judge. Okay, consider yourself buying any option. It can be a put option or it can be a call option. So if you are buying a call option, आप call खरीद रहे हो, you know, buying a call means basically you are bullish. Bullish means you want the stock price to rise. Okay, I mean, obviously to make money. Okay, so if you are buying a call option, so you are bullish in a stock. So when will you make money? When the stock price increases from lower, let's say 500, it goes to 600 or 650. Then it will be beneficial for you because you are bullish on a stock. If you are buying a put option, then you are bearish in the stock. आप stock में मंदी देख रहे हो, means you are looking at the downside of the stock. And you will make money when the stock price will fall. If let's say it is trading at 500, so you are anticipating a fall of to about 400. Why would you buy a put option? I don't know how you see the market, but when I read the newspaper, a lot of analysts feel bearish that since the market is overbought and very all-time high and all those things, you have to protect your downside. Downside means when you have a basket of your nifty stocks, to make sure that you don't lose if the market falls, you buy a put option to hedge your position. Hedge means to protect your position. Just like the way you protect yourself from the coronavirus, when you go out, you wear a mask, you wash your hands. Similarly, when you are buying a stock to save it from your downside, it's like you buy a put option. It's like, very simply, it's like saying that have you ever seen a security guard anywhere in your life? I'm sure you would have seen that. So let's say you have something which is very expensive. कोई चीज बहुत महंगी है, let's say it could be your house, it could be your office, or it could be your car, anything. You hire a security guard. What is the reason for hiring a security guard? And why do you do that? Although when you hire a security guard, you pay him a price that increases your cost. एक तो पहले बड़ा घर लो, ऊपर से security guard भी रखो, means buying a big house and then having a security guard as well. That adds the cost. But at least at the end of the day, what is basically our motive is? Our motive is that we have to protect against any fall in the prices. So we keep a security guard in our big house because we want to make sure that there is no theft in the house. And he takes care of that. So that is the reason that we pay him the money. 10,000, 20,000, 30,000, whatever is the price, we pay him that. So similarly, when you buy our nifty stocks and you have a anticipation that it can fall, you can buy a put option and you pay a premium for that. If it goes down, means the market goes down, you make money from the put option. And if it goes up, then since it is going contrary to that, nothing happened. So you just let it go. I mean, you just can't say to the security guard that you've worked for 1 month. Bhai, chori to hui nahi. So why should I pay you money? I will not pay you salary. It cannot be a thing. Whether theft is there or not, you have to pay him money. Similarly, the option will be exercised only when it will be favorable. So if it is not favorable, you just let it expire. So in case of a call option, you will exercise it if the price go up. And in case of a put option, you will exercise it when it goes down. But at the end of the day, you have to pay a premium. You cannot say ki, bhai, it didn't work, so I will not pay the premium. You have to pay the premium once you enter into an option. So in the exam, if they give you the premium of a person who is buying both a call option and a put option, then you need to calculate the premium for both, because that is your cost that has to be incurred. You just cannot refuse to pay that. That is your ultimate cost. And then gradually, wherever you will make money and try to cover up that cost from it and see the net gain. As we did in the last class for question number 7, it's on the same part. In the exam, a lot of students get confused on this second thing, beta, which is a market price and a strike price and exercise price. Students think that these are 3 different things. It's not like that. This basically market price is for the comparison purposes, just like in the current situation, they're giving you 500 rupees. Means the current market price is 500. Then you have to see the strike price oblique the exercise price. In case of a call option, since you're looking for a price to go up, move up, so you will go for an exercise price 550. So basically you are paying for something you are anticipating that it will go up. And again, to save from the downside, you're also buying a put option for a lower price, means 450. So that protects both the upside and the downside. What is the rarest situation that you will not make money? If the stock price remains at 500, because you will be exercising neither of the option. As simple as that. What the question has also asked us. In the first stance, it says the price remains at 500. So what will be the thing? We will not exercise either of the things. Why don't we exercise something? Because if something is already available cheaper at somewhere, why would I buy that? Let's say 500 was the price. After 3 months, the price remained at 505. So iska kya matlab? What is the interpretation of this? It says when I buy the call option of 500, okay, so when I buy the call of 550, that gives me a right. मेरे को हक देता है, but no obligation. जरूरी नहीं that I have to follow that. That I can buy the stock at 550 after 3 months. Means we are trying to lock in the price today itself. कि भाई after 3 months I will buy the price. I will buy the call.
It's 7:15
at 550. And for that we are paying a premium. Just like in the exam, in the question, we are paying him 30 rupees. And if the price did not move in the way we wanted and it closed at 505, would we exercise our call option? No. Why? Because after 3 months, the one you wanted to buy at 550 is available at 505. भाई जो चीज मार्केट में 505 की मिल रही है, why would you buy something at 550? You will say, okay, the maximum loss I will have is the amount of premium that I have paid, nothing else. So if something is available at 505 in the open market means on a stock exchange, why would you buy something from a person at 550? Isn't it a wrong decision? I mean, paying 45 rupees extra. So any amount which is below 550, even it is 549, no prudent person would like to buy it at 550 when it is available at a lower price. So as a reason, the call option get expired, and those who have bought the call do not get the benefit. The only loss that they have is the amount of premium that they paid. I hope this concept is clear. I have tried to re-summarize it as to what we have done in the last session. It was just like that. Okay. So now we are covering the question. Please, in the exam, you need to be very conceptually clear, beta, because paper can come from any type of conceptual clarity needs to be assessed. So if you understand the call option very properly, you will understand binomial, which is binomial model, which is very, very complex. Very complex. How to do the working and everything becomes very complex. But if you have the good understanding of the options, of the call options, then it will be very, very easy to cover up both binomial as well as the risk neutral method. If you have any doubts, please ask me. Otherwise, I will have to assume that you are understanding everything. So my assumptions could be wrong. So it is to your finest sense of judgment that if you have understood or not. Agar nahi samajh mein aaya, just tell me. If any question you want to ask me in Hindi, that's also not a problem. Okay, because the only thing I want is your conceptual clarity as far as this topic is concerned. Moving beyond that makes no point that I should just move ahead. Okay, clear? Okay, one question I'm taking up. If you have any doubts, you can ask me question even in Hindi. I can only speak Hindi, English, and little bit more. Okay, a few more languages as far as India is concerned. So please do not hesitate. Okay, and you can ask your doubts just in case you are not able to frame up your question. Okay, just in that case. Yes, absolutely, Sumit. Absolutely. So the maximum amount of loss that I will have is the amount of premium I have paid. So if I have paid a premium in call option and I'm not exercising it, so that is my maximum loss. If stock has gone up and I will let the put option expire, so on the put option I will have the maximum loss, which is the premium paid. In the first instance, which the question says that the stock price closed at 550, then I will have loss in both the cases, which is option call option also and put option also. But that practically in the real life that doesn't happen. But again, it's an exam question, so we have to tackle with it. Okay. So can we start that Now, can somebody confirm it if the visibility has come? Okay, great, guys. So I hope till here we were together. Sorry for the disruption. Okay. I was on the third point. Okay, where I said the stock price increased to 600. Okay, clear? So now only call option will be exercised, right? So profit from the call option will be equals to the difference between exercise price, which is 550, and the actual market price. So 600 minus 550 into 100. So I made a profit of how much? How much did we made a profit? That we have to see. So
it's 730.
50 into 100, which is like 5,000. We had a 10,000 profit in the put option. So 5,000 profit in the call option. And how much did we pay? Less premium paid, which is 3,500. So the net gain was only 1,500 in this case. Okay. So very, very relevant from the examination. There is no such, year in which the option has not been asked in the exam. So either way they ask you. So you have to be really very, very sure that yes, everything is clear. Okay, guys. Any doubts? I can repeat. Okay, thank you so much for the confirmation. Okay, guys. So any doubts? Anything need to be repeated, or it's absolutely fine? Okay, great. Let me now take you to the assignment question number 8. Okay. One of our dear students is asking also that, sir, please do that. So I have not started this. I'll do it now. Let me open up the assignment, students. Just 1 minute. Yeah. So again, a very, very relevant question. Question number 8. Okay. I hope the question was you are able to see the whole question. Did it missed out before that? I'm sorry, I just couldn't realize that it has been closed. So can somebody please confirm? Sumit, Chavi, Ambika, Siddharth, please confirm if the complete question is clear to you, and we can move to question number 8. If you will allow me, then only I will move to question number 8. Otherwise, I can explain you the question number, this practice manual question again. I can wait for some seconds. Okay, so Sumit is saying last question was not done. Was it the problem with everyone? I think the question you have already seen. Okay, the question you have already seen. Okay, now a little contradiction because Ambika is saying, sir, it is clear, you proceed. And he's saying from point number 1. Point number 1 has been wrapped. Okay, let me just take 2 minutes on this. Okay, then we'll move on to the next question. If any conceptual clarity will be missing, you will be covering up in question number 8. Okay, so call option purchase for 550, premium paid 3,000 rupees. Put option purchase for 450, premium paid 500 rupees. Okay, so first case was that neither of the stock price moved. It closed it at 500 rupees. So you gain nothing from the call or the put option. The only loss you had is the amount of premium that you paid was 3,500. Second case was the stock price falls at 350. So when the price is falling, so you will make money in the put option. So as stock price falls below the exercise price oblique the strike price, call option will not be exercised, right? So how much profit did you make from the put option? The difference between exercise price and the actual market price, which the examiner will give you. So 450 minus 350, 100 rupees per lot. Lot size is 100 shares. So you made a gain of 10,000 rupees. But since you have paid a premium, your net gain will be restricted to the amount of premium paid, which is 6,500. In the third case, the stock price was 600. Okay, it increases. So you will not exercise the put option. Only call option will be exercised. How much money did you make? Exercise price minus the market price, which is 600 minus 550. So you made a gain of 50 rupees in one lot. One lot consists of 100 shares, means you made a gain of 5,000. Again, that has to be restricted with the amount of premium paid, which is 3,500, followed by 1,500. Okay, guys, clear? अब तो ठीक है? ठीक है, Chavi? Now, beta, is it fine? Okay. Which is the in all the 3 cases. Okay. So just in case anything else would be left, as far as the conceptual clarity is concerned, this, so I think you can see it, you can refer to the question even from the practice manual. You will be in a situation to do that. Okay, clear? I hope now there will be no video problem because I've changed the connection completely to the another one. So shall we start with question number 8? Okay. I think assignment I've already given it to you. So equity shares of VCC Limited is quoted at 230. A 3-month call option is available at a premium of 6 rupees, and a put option is available at a premium of 5 rupees. Okay. So let me put this data. Okay. So call option purchased, put option purchased. The premium that is paid is 6 rupees per share and 3 rupees per share. Okay, at a premium of rupees 5. Sorry, not 3, 5. Okay, so the tenure of this is also 3 months. Okay, clear? So ascertain the net payoff of the option holder of a call option and a put option. So now see in the exam how the presentation has to be done. Again, a very mindful question. The strike price in both the cases is rupees 220. Okay, so I hope now you are clear, beta. What is an exercise price oblique the strike price? That is the most important thing. A lot of students keep rolling over exercise price, market price, exercise price, market price. If you still have any doubt, please ask me. But make sure, ask your heart that do you know what is an exercise price? You know what is a strike price? Both are same. In the examiner, it can be either. And what is a market price? That has to be seen. The strike price in the both cases 220. In the first scenario, second scenario, share price on the exercise day is 200, 210, 220, 230, and 240. Also indicate the price range at which the call and put option may be gainfully exercised. So the last line is also very, very, to be worked upon. That is something important. So are we good to go? Since you already had an assignment, beta, so I'm sure you must have at least read the question. Even if you're not tried, not a problem. But at least you have read the question earlier. Okay? So any doubts? Okay. No, clear hai. Okay. Thank you so much for the confirmation, guys. And sorry for that little break. Okay. So can we start from here? Let me give you full board access. Okay, so beta, we have to prepare this question in both the scenarios. One is in the net payoff for the call option, and one will be the net payoff in the put option. Okay, clear? So let's start with the first one, which is the call option. Net payoff of the call option. Okay, guys. So how much have they given us as far as the share price is given? Means after 3 months, because it's a 3 months call option. So it says share price in different scenarios starting from 200 to 240. So 200, 210, 220, 230, and 240. Clear, guys? The first thing that you need to see in the examiner is that whether you will exercise the call option or not. That is the only important thing. Okay. So here the market price is 210. Clear, guys? So that you need to see. Okay. The strike price in the both, the first one says the strike price in both cases is rupees 220. The share price on the exercise day is 200, 210, 220, 230, 240. Okay, so that's the last line that it needs to be seen. So first you assess from the call option perspective, then you assess from the put option perspective. Okay, so if the strike price is 220, will option be exercised? Okay, so if something is call option means when you want the price to rise. Okay, so will the option be exercised at 200? No. Why? See very carefully as far as the question is concerned. Okay, so as a call option, when you are buying a call option, you want the price to increase. So if the price does not increase, why will you buy something at an expensive price? So the break-even price is 220 because it says in the first line, the strike price in both cases is 220. So you will not exercise the option till it reaches 220. And then you'll start exercising the call option once it crosses 220 because that is your profit area. So yes, you will exercise that. Yes, you will exercise in both the cases until it does not exceed the 220 price. Okay. Now the thing is that how much premium that you have paid. Okay, premium paid, because here the question is on a per share basis. In the last question, I gave you with a lot size of 100 shares. So in the exam, either way can be done. Okay. So premium paid, whether you exercise or not, as you know, the premium has to be paid. It's just like keeping a security guard outside your house. So even if the theft is not there, you have to pay the security guard. It's like paying an insurance premium for your vehicle. So if nothing happened, okay, you did not claim anything, you can't say to the insurance company that I will not give you money because nothing happened to my car. You have to pay that. So that's a premium. It has to be paid in all the cases. What is the amount of premium? 6, 6, 6, 6, and 6. So this is per share. This question is giving you the amount in per share basis. Okay. So that's the thing. Now the thing is, when do you start making the money? In this case, that's again your, net payoff. So did you gain anything in this case? Okay. In the last 3 cases, because the option was not exercised. So that's your premium that you have paid. When did you start making the money? You start making the money at 230. And how much did you make the money? You made made 10 rupees. 10 rupees means 230 minus 220. In the same way, we have done it over there. So what is the net gain that you have? You paid a premium of 6 rupees. You made a gain of 10 rupees. 10 rupees kahan se aaya? The difference between 230 minus 220. 10 rupees. Okay, clear? So you gained 4 rupees positive. In this case, you made a gain of 20 rupees. How much? How did you get that? 240 minus 220. So you made a gain of 14 rupees in this case. This is how you have to show it in the examination. Otherwise, you might not able to explain it to the examiner as to how the things needs to be pans out. Okay, clear guys? Is it done? This 4 rupees, 14 rupees, can you show it in the examination? I hope so. Clear? Okay. Clear? Now can we see the net payoff we have calculated for the call option? Now we have to see the net payoff for the put option. Okay. How much premium have we paid in the case of a put option? That is 5 rupees. Okay. Some students also tell me one thing. They interpret like this. Okay. From my past experience, not from the current batch, but they said that, sir, can we say, listen carefully, sir, can we say 6 rupees is a break-even price? What is a break-even price? You start making money after you cover up your cost. So the break-even that you've done in your marginal costing, that kind of a thing. The formula, you don't need to apply that. What's the formula there? The formula is fixed cost divided by contribution per unit. That's the break-even formula that you've done in your costing. Okay. So you don't have to use that formula. You have to see the understanding of that. The minimum amount you need to earn to cover up your cost is 6 rupees. So this is your cost in any case. That's your fixed cost. So you have to cover up until it has to exceed 226. So once it exceeds 226, you will start making profit. Clear, guys? So you can interpret in that way also, as well as your understanding is concerned. Examiner may gives you even that point as well, that you tell me that what is the break-even point for a call option or put option, because papers are coming very conceptual. So you can't just hold yourself only to a single thing. Okay, clear? So can we do similarly the net payoff for the put option? Similarly in that case. So let me remain this chart like this only. Net payoff of the put option. Okay, guys. So what's the share price which is on the exercise price? Exercise day. So share price on the exercise day. What is the exercise day? After 3 months. The price could be 200, 210, 220, 230, 240. Okay. So the market price is 210. When we will exercise the option when the stock price moves downward? So the market price is 210, the price is 200. So will we exercise this option? Yes. Okay, we will exercise it until we have the price below the strike price, which is 220. So if the price the actual price is at 220, we have bought a put option at 210. Will we exercise it? Yes. What is a put option? I'm repeating it. It gives us the right but not the obligation to sell something at a higher price. So if I can sell it at a different price, why will I let it happen? I will let it expire. In case of 220, I will not exercise. No and no. Clear, guys? Again, the premium which is paid, that is my fixed cost. It has to be paid in any case. So 5 rupees, 5 rupees, 5 rupees, 5 rupees, and 5 rupees on all the 5 cases. How much did I gain? That needs to be seen. Okay. So I made a gain of 20 rupees. How did I get this? 220 minus 200. So I made a gain of 20 rupees. My net gain become 15 plus. Here I gain 10 rupees. 220 minus 210. Net gain of 5 rupees. This is positive, this is negative. In this case, since I have not exercised a put option, so there was no profit, only loss of the premium. So nil, 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 and net payoff is 5, 5, and 5. All of them. So what is the gainful price? I mean, how I can exercise that is, so my break-even price has to be to cover my cost of 5 rupees. Okay, so to cover up my cost of 5 rupees, so minimum price has to be 220 minus 5, 215. Okay, so if the stock price falls below 215, I will be in a happy situation to do that. That's the reason I did it in case of 200 and 210. Okay, so anything below 215, cover up my cost of rupees 5, which is the premium paid. And in case of a call option, it has to be the increased price. So since the 220 is the strike price, 220, okay, so 226 will be my break-even cost, and 215 will be my break-even cost in case of a put option. Any doubts? Please tell me, guys. Sir, in case of call option, Sir, in case of call option, when market price sorry, Vita Ambika, I did not understand your question. Maybe something is left, I think. Sorry, can you please write if you don't mind? Sir, in case of call option, when market price, what? I mean, can you please write? Okay, so thank you, Ankit, for understanding that 226 is the break-even point. Excellently thought processed. That's great. I just saw a little later, although, but I know that you have understood the concept. Sir, why there is a difference between? Ye theek hai, ye acha question hai. Yeah, there is a premium. There's a difference in a call and put option is because premium is generally, if the premium on a put option is lower, means the stock has gained a lot. Obviously, means the stock is playing bullish. So the people who are anticipating the stock to be bullish, they will be, again, this valuation of this options we will be doing going forward. But again, it depends upon the buying criteria of the buyers and sellers. So if there is more buying in the call option, means people are bullish on the stock. So premium on a call option will be higher. And if the stock is beaten down a lot, and the investors are bearish on the stock, then the premium on the put option will be higher. So again, demand supply concept. Sumit, हाँ, ये अच्छा लगा. देखो, नंदा जी ने सवाल हिंदी में पूछा. So that's the best thing. Okay, let me understand what she's asking. मार्केट प्राइस को ही कंसिडर करना है ये स्ट्राइक प्राइस को. पहले बेटा आपको मार्केट प्राइस एग्जाम में करना है. ओके, सो शी हैज आस्क्ड मी अ क्वेश्चन इन हिंदी. आई एम आंसरिंग हर इन हिंदी. I like her spirit to be very straightforward. Okay, So the question is very valid. Those who understand Hindi, that's fine. Otherwise, I'll repeat that. Market price को ही consider करना है strike price. ये सवाल बहुत अच्छा है. देखो सिंपल सी बात ये है बेटा. In the exam सबसे पहले आपको देखना है कि मार्केट प्राइस कितना दिया और स्ट्राइक प्राइस कितना दिया. 3 महीने के बाद जब आप ये सारी कैलकुलेशन करते हो स्ट्रीम वगैरह की, तो नंदा जी यू हैव टू सी द स्ट्राइक प्राइस. अगर स्ट्राइक प्राइस आपके फेवर में है तो ही आप उसको एक्सरसाइज करोगे. स्ट्राइक प्राइस आपके फेवर में नहीं है तो उसको आप ऑफर नहीं करोगे. यहाँ पे बेटा आपका स्ट्राइक प्राइस 210, उससे हमारे को मार्केट प्राइस दिया था, बट हमारी सारी कैलकुलेशन का क्राइटेरिया किस पे डिपेंड कर रहा था? इस स्ट्राइक प्राइस 220 पर. अगर मैं कॉल ऑप्शन को बाय कर रहा हूं, सो कोई भी चीज 220 से ऊपर आएगी तो मैं एक्सरसाइज करूंगा, अदरवाइज नहीं करूंगा. पुट ऑप्शन केस में कोई चीज 220 से नीचे आएगी तो मैं एक्सरसाइज करूंगा, अदरवाइज नहीं करूंगा. आई होप अब आपको क्लियर हुआ होगा. आई एम श्योर, मतलब मेरे को गट फीलिंग है. ठीक है गाइस, क्लियर है? कैन वी मूव टू द नेक्स्ट कॉन्सेप्ट? Any further questions you can ask me. That's not a problem. Okay. So to end this topic, which is the options, let us complete question number 11, which is also similarly like this, and then we'll cover up question number कौन सा रह जाएगा 9, 10 and 12, and we will end this session. ठीक है ना? Any other doubts you can ask me, guys. Sir, when MP Sir, when MP? Ambika ji, I don't know why your questions are coming limited. Now it's saying, sir, when MP? Bas. कोई बात नहीं. I'll cover up your question. Nothing to worry. Okay. Those who have understood, those who are live with us. Okay, great. Okay. Thank you. Thank you, Nanda, for the confirmation. Raghu. Like futures, whether we can use options for hedging. Thank you, sir, for your lectures. Acha, nahi, most welcome. That's my duty to explain you. So thank you for your kind words. But your question, like futures, whether we can use option for hedging, absolutely, absolutely. I think Raghuji, I told you, I think in the last class, last Thursday, that options are used for hedging purposes. So you can either buy a call option, but that will increase your cost, means when you are paying a premium, so your cost of buying increases, or you can short a call. Call option को short कर सकते हैं, but the amount of shares that you have, the lot size should be equals to the option lot size. तब आप कर सकते हैं. Okay, clear? चलो, okay Raghuji, clear? So should we good to go for 11th? Please confirm me. So I'm rubbing whole of this. I hope in the exam also you will show your presentation like this. Okay, clear? So better the question that we are doing right now, which is question number 11, it is more from a, you can say it is more from the valuation perspective, means the last model that we have to cover up. But I thought I would like to cover it over here because a lot of options are there. Now see carefully, now it's a 4 months call option, okay? 3 months we have been doing, it's a 4-month call option. After that, we'll move on to this thing. Because this expected price and all those things are a part of a valuation model. So I just thought ki, we'll cover up over here. Again, nothing, not very technical. You are an investor that has purchased a 4 months call option on the equity shares. So since you are buying a call option, you are bullish or bearish. Ask your mind, ask your heart. Okay. Yeah, so those who are thinking bullish is absolutely correct. So since you're buying a call option, you want the stock price to increase. Of rupees 10, the current price is 132. अब नंदा जी का सवाल आ गया. and the exercise is 150. So sir, क्या देखना exam में? Okay. So the current market price is 132. Okay. And the exercise price is 150. This is what she asked, and I know her question was absolutely valid because a lot of students thinks as like that only. So the current market price is 132. The exercise is 150. I will exercise my option only and only when it exceeds 150. Okay, I'm repeating. मैं अपना कॉल ऑप्शन तभी एक्सरसाइज करूंगा जब प्राइस 4 महीने के बाद 150 क्रॉस करता है, 150 क्रॉस करता है. That's the question that she was asking, and which is a very valid question. A lot of students have this thing in their mind. Okay guys, so अगर वो 150 से नीचे बंद होता है 4 महीने के बाद, मैं अपनी कॉल ऑप्शन एक्सरसाइज नहीं करूंगा. मेरे को मैक्सिमम लॉस कितना होगा, जितना मेरे को क्वेश्चन में प्रीमियम दिया हुआ है वो मैं एग्जामिनर को बोलूंगा दिस इज द लॉस दैट आई नीड टू डू. Okay guys, clear? Sorry for taking this lecture a lot in Hindi today. Okay, I know that's not professionalism, but if I'm able to explain a concept in Hindi, that I really don't mind. I have taken permission for viewers that if I speak something in Hindi, I will retranslate that in English. Okay guys, so you expect the price range to be 150 to 120 to 190. So now this is very clear. Your break even price is how much? 150 is the exercise price, and the amount of premium that you paid 10 rupees. So your break even price is 160 rupees. Very simple. Chicken. Second, expected price is given to you with the probability is given to you. So again, very simple. We have done it in C enter. If any probability is given to you against anything expected, so you can calculate the overall expected thing with the help of using a probability. That's again very simple. Chicken? Clear? Yes, Chavi, absolutely. You are right. Although you are always right, you know, all the time. I've not seen any time you have not been right. So let's cover up this up. Where is the question? Okay. So the first is expected price in 4 months. Okay. So this is simple. The expected price 120 into 0.05, 140 into 0.20, 160 into 0.50, 180 into 0.1, and 190 into 0.15. The sum will be 1. Okay. And you will get a price. Let me see. Somebody has done that till the time I was speaking. Okay. So thank you. It's like 160.50. Okay. Others can check. Okay. Ji, clear? So the question says the market price is 132. So in the exam, do we have to see that? Yes, if we are buying a call option, the exercise price is 150. Okay. The premium is 10. Okay? This is the thing. So I will exercise. मैं अपनी call option कब exercise करूंगा? When it has to exceed 150. In the exam, just write these 3 things. Nobody can make you fearful on this. Okay, आपको कोई नहीं डराएगा. If you identify these 3 things in the exam, what is the market price? You write down. What is the exercise price? You write down. What is the premium paid? You just write down. Then you ask your heart. If the price crosses 150, I will exercise the call option. But my break-even point will be 150 plus 10 rupees, which is 160. I'll start making money only from 160 onwards. Clear? But I will exercise it after 150, but my profit will come from 160. Samajh, both the things are different. My reason to exercise an option will start post 150. my reason to start making profit will start from 160 rupees. Why? 150 plus 10 rupees तो मुझे cost cover करनी है. उसके बाद I'll start making the money. Okay, in the exam, these three things you need to see. Clear, guys? So 160.5 is correct. Thank you so much, Sumit and Chavi and Ambika. Thank you. Clear, guys? Second is, it says value the call option. Now see, this line is very, very technical. I hope you have the assignment with you. Hai na? I hope you have that. Last time it says if the exercise price prevails. In the exam, a lot of students did not understand this line. Did not understand this line. Do you want me to show you? One second. See this line. Value the call option at the end of months if the exercise price prevails. What does this mean? It simply means that exercise price prevails means that this is what I have written. Now it will be clear. It says, come here. If exercise price prevails, it means that actual stock price was also 150 on that day. Now what to do? I said I will exercise the call option only when it exceeds एक रुपया भी बढ़ेगा. एक रुपया क्या मतलब 5 पैसे भी. You have a tick size of 5 paisa. So even if you increase by 5 paisa, then I will exercise that. If exercise price prevails means if the stock price at 150, the call option will be nil. Why? I did not make any profit. Sir, but loss bhi to hamare ko premium ka. But the examiner is not asking me that. The examiner is saying what is the value of the call option. The value of the call option means nil, means I did not exercise that. Sir, if they ask that what is the gain or loss if the stock price prevail, then I would say yes, the value of the call option is nil and the loss which is rupees 10 on account of the premium. But the examiner is asking me what is the value of the call option. That's the thing. Chicken, clear? You will understand this value of the call option even more intensely after 15-20 minutes once I'll start with a binomial model. That you will understand even more, much more greater detail. Okay, clear? Sir, comparing, we should not take premium into account. While comparing, don't take the premium. Good question, Ambika. I mean, really blessed to have such students. Let me repeat her statement. She says, sir, comparing, we should not take the premium. Yes. So at the time when you want to exercise it or not, you want to see that it has to exceed with the exercise price. And premium has to do nothing with that. No comparison. But if the examiner is asking two things, they can ask only two things, is what is the gain or loss? Or secondly, they can ask what is the break-even point? So in that case, you will consider the premium. Theek hai, Ambika? Clear hua? She's from Mumbai, although I know Marathi, but that will become a little tough. So I know she can understand Hindi and English both. So that's the thing. Guys, clear? So we don't have to consider the premium unless the examiner is asking us either number one, which is called as your break-even point. Number two, what is the gain or loss? If they're asking simply what is the value of the call option, the value of the call option is nil because the exercise price and the actual stock price was same. So nothing was exercised. Last is, in case of the option is held to its maturity, what is the expected value of the call option? Now comes the maximum importance that you need to cover up. This is clear? अरे वाह सुमित कहां से इतने बढ़िया सवाल आते हैं यार कितनी सही चीज पूछी सर is there any M2M in case of an option hats off good question वैसे what do you think होना चाहिए कि नहीं what does other things let's see if you'd like to answer this gentleman's question he says sir is there any M2M in case of an option are we supposed to pay any M2M Question is brilliant. Answer is also hidden there only. Okay, I'll address in 2 minutes, Sumit. Okay, let me complete this third part, then I'll cover up your question, then followed by all those things. Okay, expected price 4 months. Okay, till maturity. Okay, expected your expected value of the call option in 4 months. Okay, so expected price is 120. Okay, 140, 160, 180 and 190. Clear, guys? So value of the call option that we need to calculate. In case of 120, 0, 140, 0. Why? I will start exercising the call option once the price exceed. See this exceed ka sign. It has to exceed that. And in case of 160, yes, the value of the call option means exercise price minus the expected price, which is rupees 10. 150 minus 180, 30. 150 minus 190, 40. And the probability of getting this value of the call option R. So although it is 0.05 probability, 0.2, 0.5, 0.10, 0.15. Okay, so the price will be 0, 0 in this case, because multiply with this will comes to 5, 3 and I think 6. I think so. So it comes out to be 14. Please check, huh? Please check if I have done it correctly. So that's your answer. I hope this is clear. Now let me address Sumit's question, sir. Is there M2M in case of options? So this brilliant girl called Ambika has answered, which is absolutely correct, that there is no M2M. Better see very logically, very simply. Okay, to wind up the complete option, because now the options are complete. So your question is valid and can be answered right now. See, in case of an option, when you're buying an option means buying a put option or buying a call option. When you're already paying a premium, so there is no point of an M2M. So even if the stock price moves this side or that side, your premium is paid, you are having a good sleep. That's not a problem. When you are selling a call option, okay, or a put option, then also there is no concept of M2M, mark to market, because your margin is covering up that. Margin means the already amount that you have given in case of in form of shares. So the the broker is taking the margin from your shares. So if it exceeds to a limit, then he can sell off your securities and cover up that huge premium amount. So he has all the right, but again, he can't touch your demat unless you give him the permission to do that. But yes, for the margin, if you have the shares and you have sold a call or a put option, then he can take the margin from your shares, but there is no concept of M2M in case of options. I hope that's clear, guys. Okay. So thank you, Chavi and Ambika, for confirming that this is the answer. That completes my options, the concept of options. Okay. Now we are covering up the next topic, which is called as the valuation models. But before that, I have a little theory to explain you the concept of intrinsic value and the extrinsic value, so that you understand the binomial risk neutral method very easily, and then followed by the Black-Scholes model before we end the class. Okay, ji? So can I rub this? So before we actually start the concept of the valuation models, means option valuation techniques, it is also important to understand one thing which is called as the option premium that you will be required to calculate in the examination is basically constituent of two things. One is called as the intrinsic value, and extrinsic value. Okay, this is also called as your TVM, the time value of money, the one you have studied in your C-Inter in your FM, the very first chapter, the time value of money. So that determines the option premium. Okay, so what we have done, I also ask her why the premium between call option and put option is different. So the option premium that we have paid, like in the questions we paid, are call option at 6 rupees per share, put option at 5 rupees per share. From where do these values come? This is a combination of two things. One is called as the intrinsic value and one is called as the extrinsic value. Okay, clear? So in the exam, although you are not supposed to calculate any intrinsic value or the extrinsic value separately, and then you think you might have to add both of them and to get that, no, it's not required. Whenever you find a particular value in the exam, the examiner asks you to calculate the option premium from either three methods. One is your binomial, second is your risk neutral, and third is your BSM, which is Black-Scholes model. So the amount that you get is already a composition of these two. So you have to understand that how do these are correlated. Okay, basically. So the answer that you will get in exam is that already वो इन दोनों का ही total होगा. You don't have to calculate that separately in the exam, but it is just for the purpose of understanding as to how the
it's 8:15.
Let's say how the things are being calculated. Okay. So let's say, see now carefully the example I'm giving you. It is little opposite of what we are doing in the question. Current market price is 200. Okay, clear? Exercise price is 195. See very carefully. In most of the question that we have done, the market price was lower and the exercise price was higher when we are buying a call option. Just like in the last question, my market price was 132 and exercise price was 150. So market price was higher than exercise price. I know this is what I'm doing. I'm just trying to tell you how do you calculate the total option premium. Okay. So this is opposite. Here the market price is higher, the exercise price is lower. Okay. See very carefully. How do you get the option premium? In very simple words, okay, I would say that currently the market price of a share is going at 200 rupees. You want to buy a call option having exercise 195. Okay, so it means technically you are already in the money. Yes or no? Are you in the money? Yes. The market price is already 200. You want to buy a call option means at 195. Okay, so that is technically in the money. How do you calculate the option premium? It consists of the intrinsic value, which is 5, the difference between 200 and 195. And extrinsic value means time value of money. Okay. So let's say if it's a 3 months call option, you started in January, it will get over in March. So if you buy in January, just an example, you are paying a time value of money of 3 rupees. If you buy in February, you are getting closer to the time. So you are paying a extrinsic value of 2 rupees. So as you come in March, means 1st March, you're paying a extrinsic value as 1 rupee. So as you start moving near to the expiry, what is this March? This is your expiry. 3 months call option starting from 1st January 2021 and ending at 31st March 2021. So when you're buying something, particular call option in the starting of the call option, you pay a higher premium. Why? Because the time value of money prevails at a greater amount. So you have to pay a higher premium amount as far as the extrinsic value is concerned. So if you're buying it at January, you pay a premium of 3. So your total premium becomes 8 rupees in case of January. If you pay in February, it comes to little lesser. It reduces as you move towards the expiry. Time value of money gets little weaker. So you pay 2 rupees. So you end up paying 7 rupees. If you're buying something in March, so you end up paying only 1 rupee. So total amount comes to 6 rupees. So the concept is very simple. In the exam, although you are not supposed to calculate all these things, again I'm telling you, exam mein jo bhi question aayega, it will be the 876 value. But this is just for your understanding that the premium that you calculate or you pay to the exchange, it consists of 2 things. One is the intrinsic value, means the difference between what is there, the difference between the market price and the exercise price, and followed by the time value of money, which is called as as you go near to the expiry, you start paying less. Because why, sir, it becomes 1? Because in March we can see what is the what will be the price at the end of the March. In January we are not very sure that what will be the stock price after 3 months. So we have to end up paying a higher premium. And as we go towards the near the expiry, the time value of money reduces and we end up paying a less premium. And if you are buying a call option, as I told you, it's a European option. Okay. So as if you buy a 31st March expiry option on 29th March, so even this 1 rupee becomes hardly 5 paisa or 10 paisa. Clear? It converges towards this price. So as you come on 31st March, this will become 0 and this will become equals to the difference between exercise price and the market price if this remains at 200. Okay? अगर वो तब भी 200 पे ही रहा, so the difference will be actually on the expiry date will be the difference between exercise price and the market price. But before that, if you're buying some call option, you have to pay a premium. The longer time period you will have, the higher premium that you have to pay. The shorter time period you have, the lower time, the premium you have to pay. Okay, the premium means the TVM. Otherwise, the intrinsic value will remain same. It converges on the day of the expiry. Clear, guys? Okay, Sumit. Yeah. So means for option, first those shares have to be in your demat account. Means when you are okay, that's your not related to this. I'll cover. Okay. So I hope this concept is clear. Okay. So again, in the exam, I'm telling you, you have to calculate this value in totality. But this was just for your own understanding as to how this thing happens. Okay, guys, clear? So if any doubt, then I can this thing. Otherwise, I can start with the option valuation techniques. 3 techniques will be covering up. Okay, so now let me first cover up his questions. So means option, first you have to have those shares in the demat account. Yeah. So if you are going for any naked call option, so you have to submit a margin amount to your broker. But if you are selling a call option, so you should have equivalent amount of shares in your demat. Otherwise, your margin amounts increases. Okay, Sumit. for means for every month, time value will be month. No. That is just a, I mean, you're saying ki as we go, keep on increasing, that reduces. That's just an assumption. Okay. Again, this depends on how much buying in that stock is happening. Okay. Again, that demand supply concept is there. But that was just for an example. It will not always be ₹1. It could be 10 rupees. It could be 50 rupees, depending on which stock is it there. Okay. So if a lot of buying, selling is there in that stock, the TVM will be a very higher amount. Obviously, the intrinsic value will be higher. The TVM will be there. Okay, clear? So just to give you an example, very simple example related to this. Okay, since you have asked me something, then I'll move on to the examination related. Yesterday, what I saw was very astonishing. TCS was trading at 28.50. Okay. Why? Because there's a buyback which is coming. A record date has gone. Till first you have a buyback at 3,000 price. So when you have such kind of a news now, so a lot of things keep happening. And you know what? It was the actual price yesterday. And do you know at what the call option was valued? Call option expiry कब की थी? 31st December. अभी आनी है. 31st December 2020. 2850 की. It was trading at 55 rupees. The same call in the money, the example which I gave you, 1-2 rupees just now. So since it was exactly the same, the market price and the exercise price was same, it was still trading at 55 rupees premium. When even the expiry is very near, hardly 1 or 2 weeks are left. And in this week also, there is so many holidays. You have a Christmas holiday and all those things. So still it was trading at 55. Means the intrinsic value was 0. There was no intrinsic value because both the prices were same. This 55 was the extrinsic value. That is the time value of money. Because a lot of buying and selling was happening in this TCS ki call. Because TCS is going for a buyback at 3,000 rupees. Okay, so that was the thing. Yeah, okay. I hope that's clear. That was just a practical part. You don't need to indulge yourself into any this thing. It is just to explain you the concept of the extrinsic value. That's the thing. That even if the market price and the exercise price are same, you can see it was trading at roughly 2850 only yesterday, and the call option at 2850 means both were same. So the intrinsic value was 0. And what is this 55 rupees is? This is the time value of money. So even if the expiry was very near, it was trading at 55 rupees. So imagine, I mean, lot of premium pay. Okay? Yeah, Lakshmi. So if we buy in February or March, will the 200 still be the spot price? Yes. See, beta, this remains same. Okay, this you can't change that. So if you are spot price keep changing, you have to just see that what is basically your exercise price in the exam. If you are buying a call option, the call option will be exercised only when your exercise price is higher than your market price. So in the exam, you have to first see that if it exceeds, then you exercise it. Otherwise, you just let it go. If you're asking for a practical perspective, what if your question is that if you're saying if you are buying in March, if you are buying March of February, stock price will 200 be a spot price. Spot price can be anything. Okay, it could be anything, 200, 250, 210. It could also go to 100 rupees. So again, exercising a call option or not exercising depends that it should exceed, then only you will exercise that. Very simply, I can say in that those words. ठीक है ना? हम तभी exercise करेंगे कोई भी call option जब spot price कम हो और exercise price ज्यादा हो, तभी exercise करेंगे अगर हमने call option को buy किया है. Okay, guys? I hope this is clear. Now we can go to the option valuation techniques now. So that TCS was just for your examination, not examination purpose, that was just for the example purposes. So once you clear your chartered accountancy, you will start understanding option in a very well manner. So as you know, the time value of money is giving you 55 rupees, which is free of cost. So you can grab those 55 rupees, multiply by the lot size of TCS, which is 300. So that will be your free money. So this way you can start exploring options. Once you complete your CA, then you will have a good amount of, money as far as these options are concerned, if you have a good understanding. So now we're covering up option valuation techniques. Okay, how do we do that? Okay, so basically what you have to consider in this, the theoretical value. Okay, theoretical value of option, which I have just spoken, is the difference between exercise price minus your spot price, which is also called as your market price. Same thing. Spot price means आज क्या price है? What is the spot price right now? So the theoretical value has to be exercise price minus the spot price. Okay. So in the exam, you don't need to calculate the intrinsic, extrinsic separately. You just have to calculate the total premium. And how you can do that? The first technique to calculate the theoretical value of the call option is, of any option, it could be call or put, is number one, binomial model. Okay. What does basically binomial model does? Just like the way we have done in question number 11 of the assignment. So it gives us the expected price of the stock. Okay. So what does it do is, see very carefully, it breaks. What does it breaks? Down time to maturity. Okay. Into large intervals. Into large number of intervals, time intervals. Okay. Using expected probability. Just like in question number 11, they gave you 120, 140, 160 and the probability of each of them. Okay. And then we are required to calculate such valuations. Okay. So you buy a stock at 100 for a 3 months. What is the possibility? Only two possibility will be there. In the real life, in the exam, you can have a same thing, but reality may, what happens? Either it can move to 200 or it can have a value which is 50. Simply. The stock will have only two values. It could be little higher or it could be lower. Okay. So you have to see the assessment of, in that case, if it goes higher, because if you're buying a call option, so you will exercise if the price will move up. So what will the value of that call option? This examiner can ask you. He can also ask you that if the price has gone down, what will the value of the put option? So in the exams, a lot of time in the history, value of the call option has been asked a lot many times. But again, I really can't be sure that they might not ask you anything which is called as your put option. They can ask your put option as well. So be ready for that. It's a very conceptual paper. Okay. So the movement can happen either positive or it can be a negative situation. Means it can come down. So if you are buying a call option, you will only make money if it exceeds. Otherwise, you have to just let it go. Okay. So again, having 200 can have furthermore possibilities. 80% is it can go up. Other 80% can go down. So what will the value? So the logic to calculate these things is that at the expiration of the option, we get to know the final possible stock price by moving backwards. Clear? So the only thing in these three techniques have in peculiar is the option valuation techniques, the 3-1, which is binomial, risk neutral, and BSM. The only thing is that you understand this concept only and only with an example. That's the problem. So whatever theory that you study from the study material or the steps that they tell you, you will not understand anything unless you do a question. Okay. So I am first sharing the steps that needs to be followed. I know you will not understand more than 10-15%, and that will be clear only and only when you are able to solve the question. So what are the steps is, first, as I told you, to calculate the value of the option from the binomial model, you need to see what is the possibility of the stock or possibility of going up and down. So examiner will give you both up key probability and the down key probability. Possibilities, followed by such probabilities. Like in question number 11, we had that 20%, 5%, all those things. Then you have to prepare a binomial tree. Very important from the exam. Very, very important. Showing expected price and the payoff. The most complex thing in the whole derivative chapter. Decide whether to exercise or not, and calculate the value at each node. Now, what is a node at each point? And finally, at the starting point. Means first you calculate from at the last, then previous, then come to the starting point. The most complex thing one could have. But after this, you will find this very, very easy. Trust me. And in the exam, you will be able to cope up with that. So you have to move backwards. Study the steps. So even if you understand 10%, at least I'm sure you can understand these two steps. What is the possibility and what is their respective probabilities? Just like the way we did in question number 11. The possibility was 120, 140, 160, 180, 190, and the probability of each was given to you. Now, you can't just end up your question like this. If they're asking you to prepare a binomial tree and the payoff, then you have to start doing at each node. In that, the knowledge of the call option and the put option is very essential in the exam. Please do not ratify this. I will cover up the question number 9 in extremely slow pace. If you face any doubt, stop me there. Ask 10 times, 20 times, 40 times, 50 times, not a problem. But make sure that you leave this session after digesting the concept, because it's very important. A lot of students doesn't understand. Last paper, November, May, the Black-Scholes model have already come. Okay. So you never know, any other method can be asked, like binomial or risk neutral, or BSM can be asked again. So make sure that you don't leave anything from the examination perspective. Okay. And then you have to prepare a tree. How to prepare a tree, I will explain you. Decide whether to exercise or not, I will tell you. And evaluate the each node. ठीक है जी? So I'll stop sharing, and I can able to explain you this concept only and only with a question. I can't, even if I do it with an example, that makes no point, because if a brilliant question is there with us, why don't we do it with a question only? Okay? So I hope the steps is clear now, and I will be in a situation to share it with you. The question number, no, sorry, not 12, 9. Please read this. Yes, Sumit. In the practical life, how probability is calculated? Which probability? Stock price probability. That depends upon you. What is your gut feeling? See, probability, what is probability? It's just nothing but a guesswork. It's just a guesswork. Today, will it rain or not rain? It's just a guesswork. 50-50. When you see your iPhone or any phone, you see the chances of rain. It gives you, let's say, 10%, 20%, 40%. I know for that. So again, it's a guesswork based on several things. So in the real life, we generally don't have that kind of a probability. But yes, in the exam, we have to do that. Please read question number 9. I'll read it with you. Let me clear the board. Can we start, beta? Question number 9. Consider a 2-year call option with a strike price of 50 and the current price is also 50. Assume that there are 2 time periods of 1 year, and in each year the stock price can move up or down. See this line, beta. Can move up or down by the equal percentage of 20%. Down भी 20% means 80 हो जाएगा. Up means उसका value 120 times हो जाएगा. 50 का 120 और 50 का 80% means downside. Okay. The risk-free rate is 6%. How to interpret this, we will see. Okay, nothing to worry. Using binomial option model, calculate the probability of the price moving up and down. Okay, so with this, we can understand that we have to use a what do you call this as the binomial option model. Calculate the probability of price moving up and down. Also draw a 2-step binomial tree. Showing prices and payoff at each node. Each node. Each node. 2-year possibility. Okay? Are we good to go? So as we have written the steps, we have to move backwards. So we'll start from the last node and then we'll start from the time 0. Clear? Any doubts, guys? I hope you don't mind me going extremely slow because this is quite tough, huh? Since you're doing it for the first time. Okay, guys. So what they are saying is, what is basically a binomial tree? How do we have to calculate that? We can say we are at this point, okay, means T0. T0 means as on today. Now there will be 2 possibilities of price going up and price going down. Let's name it as B and C. Since it's a 2-year period, okay, 2 time periods of 1 year, and in each year the stock price can move again up and down by equal percentage of 20%. It can further from here can go to 2 possibilities, okay, going up, going down, and same is that case. Clear? It's a 2-year period. This is T1, this is T2. Okay, the examiner may give you 3-year, 4-year, depending on the marks distribution. So you have to be just ready for that. Okay, I hope this is clear. Now, how will the actual graph look like? At point A, the strike price at 50. Okay. Sir, ये price कौन सा लिया आपने? Is it the market price or is it the exercise price? It has to be the exercise price. This will determine us that whether we should exercise a call option or not to exercise a call option. Sir, has he given us that? Is it a call option? Yes, he has given us a call option. Sir, can he give us put option as well? Absolutely. So that is scary. So what can I do? You have to be ready for everything. I'm not scaring you. So it's a call option. Okay. So A started at 50, the exercise price got 50. Okay. The possibility of going the price up, which is 20%. So up 20%, down 20%. So 50 ka 20% is 60. 50 ka down 20% means 80%. $40. Is it clear? I am repeating because I know it's a very tough concept. I started with node. These are called as your nodes. Okay. Sorry, I forgot to name them. Sorry. This is your D. This is your E. Okay. This is your F. So you have A, B, C, D, E, F. This is time 0 as on today, time 1, time 2. Why I said 2 years? Because the question has said, it's a 2-year period for both up and down. Simply. Okay? Now the thing is, the first possibility of going up and the first possibility of going down for T1. First period, time period 1. Now further possibility, it can go to another 20%. 60 का 1.20 कितना हुआ? 72 point D. Okay. And the possibility of going down, 60 का 80%. 48. 40 का भी 120% is also 48. And 60 cut 80% is also 48. So this becomes a E point. $48.
It's 8:45.
Then F point, okay, which is falling down. 40 ka 80%. Before you proceed further, please guys, tell me if you have a problem. I can remake that. I don't have a problem. Okay. No, G is not there. Sumit ji, G is not there. Okay. G is not there. I'm making this even bigger now. Okay. A, we started at 50. Prices go up 20% say at 60. This is node number B. So all are same, huh? I'm just making a little bigger one. Nothing new I'm doing. Price go down at point C. Iska 80% means 40. Further B has two possibilities. Stock price moving up at D. 60 ka 20%, that is 72. 60 going down by 80% at point E, 48. C ka price going up at 48 and price going down at point F at 32. Clear, guys? So 50, two possibilities, 60 and 40. 60 ki further two possibilities, 72 and 48. For C, two possibilities, going up by 20% means 48 and probability of going down, which is 32. If this node is clear, so your first point is clear, at least to identify the nodes, and then the calculation will come. अरे अंबिका जी बेटा स्ट्राइक ये एक्सरसाइज प्राइस तो लेना है, अभी बताऊंगा. I'll just tell you why I'm taking this the exercise price, because whether we have to exercise it or not, we'll discuss in second step. Just 2 minutes, Ambika. Okay, this is clear. Is the diagram clear, guys? See again, 50 ka 20% up, 60 rupees हुआ stock price. A का 80%, which is 40, means price going 80% down. C will have further two possibilities: price going up by 20%. ऐसे कर देते हैं, increase 20%, decrease 20%, increase 20%, decrease 20%, increase 20%, decrease 20%. 20% decrease means 80% of that value. So 40 ka two possibilities, 48 and 32. B node ka there are two possibilities, D and E. So D is 20% above, which is 72, and 20% down, which is 48. You can do the calculation. It's very simple. Okay, 60 ka 80%, 48, 60 ka 120%, which is 72. I hope this node is clear. I hope this node is clear, guys. I hope so. Then we have to move to the next step. Okay, how to fulfill these nodes. Okay, I hope this is clear. Can I rub this completely and do the calculations? Okay. Don't worry. I'll write this, all of them again. Okay. So this value was 60. 60 was there. 20% से move करेगा, right? 60, 40, 72, 48. Clear, guys? Now we have to start from the backwards. Okay? So you have to start from the backwards before we do any starting. 50 is basically our exercise price, and the actual stock price moves to 72. We will exercise the option or not. Very careful. Be very careful. I am repeating my question. I bought a call option of exercise price at 50 rupees. The actual price was 72, 48 and 32. Three ke case mein discuss it. Will I exercise the call option? Yes. I can buy something at 50 when the actual market price is 72. Will I explore this opportunity? Yes. I bought a call option at 50. The actual stock price is at 48. Will I exercise a call option? No. Why will I buy at something at 50 when something is available to me at 48? So the value becomes 0. Will I buy something at 32 at 50 when the price is at 32? No. When I am a buyer of a call option, I am bullish in nature. And if it exceeds the actual price, then only that option will be exercised. Okay? So if I exercise this option, how much profit will I make? So premium, abhi nahi. Let's leave the premium right now. What is the amount of profit that I will make by exercising this option? 22. 72 minus 50 is 22. 72 minus 50 is 22. Am I exercising this option? No. 0. Am I exercising this option? No. 0. Clear? 22 is my profit in the first case. 0 and 0 since I am not exercising that. So I have calculated the last node first. Then I have to calculate the value of this node and finally the value of the option at node A. Okay. In the exam, what is the value of option at node A is the requirement. That is constituting your maximum marks. And you will get this value only when you start moving backward. So you calculate this first, then this, then this. Then you get the full marks. That is the steps that you need to follow. Sorry, just looking at the questions, just in case you have. Yes, Ambika, what you've written is absolutely correct. Which moves up, absolutely. Okay, so since the market price has moved up, I will use the call option and make a profit of 22 rupees. Sir, but what about the premium? Abhi, we don't need to calculate the premium. Know the premium because that is what we need to calculate that. Okay, so ideally, if that is a possibility, what should be the call option at point A? That is a requirement of the examiner. And how to calculate that? Should we do that? So I know you understand the requirement. So examiner क्या पूछ रहा है? ये value. इसकी A point पे what is the value of the call option? That is what the examiner is asking you. So should we calculate that? ठीक है? This value. So the first step is the last node. Which one we should be exercising? Which one we should not be exercising? That's the first point. Clear? So first we have to calculate the probability of price increase. Probability of price increase. And this is calculated using a formula. See very carefully. So probability is equals to R. R is the risk-free rate, which the examiner has given you 6%. Minus small wala d divided by U minus D. Sir, what is this U and D? Simple. Decrease in the value and increase in the value. Means upper value and down value. Simple. This they have given you 20%, both up and down. Sir, can it be a different also? Yes, in the examiner it could be a different also. But just this is a basic model, so at least we can try for the basic. So what are we doing? The probability of price increase. Price increase की probability using this formula R minus D divided by U minus D. In this case, both D and U are the small letters. R is the bigger letter. So how do we calculate this? See very carefully. The risk-free rate is given to you as 6%. 6% expressed in this form. Okay. What is the decrease in the value? 80%. Increase in the value? 1.2%. How to present that? Minus 0.8 divided by U is the upper value 1.20 minus 0.80. Is it clear, guys? Please be a little cautious. You are humbly requested. 1.06, that is the risk-free rate, minus the down value, which is 0.8, up value, which is 1.2, minus 0.8. Okay, so this will give you 0.26 divided by 0.4, I think. Hai na? Clear? 0.65. So there is a 65% chance that the price will move higher. Is it in your favor? Yes. Why? Because you are buying a call option. Buying a call option means you want the price to increase. And there is a 65% probability that the price will increase. So what is the probability of decreasing the price? 1 minus of this. The total probability is always 1. So there are 65% chances that the price will increase. So what is the chances the price will decrease? Probability of price decrease. %35 chance that the stock price can decrease. This both probabilities we have to explore it over here. Clear, guys? So first you have to calculate the value at node B, then followed by node A. Okay, I hope this value of the this options are clear to you. From where did I get 22? 0 and 0 means we are not exercising the options. Okay, so that is your single period binomial model. Now you have to calculate the value option at point B. Now value of call option at node B. This point. Why? What will be the value at this point? It will be 0 again. Sir, here be 0. Yes. Means why would I buy something at 50 when it is available at 40 in the open market? If the price go down, ye kya tha? This was a downer price. Will I exercise my option if the price goes down? No. So my value of the call option will be 0. 0, 0, 0, 22. This I have to calculate, and then I can calculate this main requirement of the examiner. I hope you are getting the sense how are we planning out this thing. First, start from the last 22, 0 and 0. Come to this point. The probability at, the value of the call option at point B. You have to calculate followed by A. Why? Because we will not be exercising the option at point C, because call option is not exercised when the stock price falls. If the put option would have been given to you in the exam, then this would have been a positive value and this would have been a 0 value. So anything can come in the exam. Okay, I'm discussing about the call option. So first you have to calculate now the value at point B, the note B. Okay, so see the formula very carefully. Write down in your heart. Okay, make a tattoo and write down, because this same formula you will be using in the risk neutral method as well. So what is the formula to get a call option? C means the call option value is call option at upper value UP. Okay, not Uttar Pradesh, the upper value with a probability.
It's 9 o'clock.
Okay, U into P. So U into P, probability means this one. Okay, plus C D 1 minus P. The probability of increase in the prices, the probability of decrease in the prices, respectively 65 and 35, divided by R. Learn this one, the numerator, because this will be using in your risk neutral method as well. Okay? Again, simple. I mean, that was on a lighter side. He make a tattoo, because this is very simple. This is straightforward. Okay. So the upper value 22. The possibility to get the upper value is 22 multiplied by 0.65. The value downer, which is 0, having a probability of 35. In case of a call option, you will have only exercising the upper value, and in case of a put option, you will be exercising only the lower value. But for the timing, the question that we are doing, you have to see that this is the upper value where exercising the call option and making a money of 22, having a probability of 65% of the increase in the prices, and we'll not be exercising the rest one, which is the 0 multiplied by 0.35 divided by R. R is, the examiner has given us 6%. So 1.06. Please just tell me if it is clear or not. If not, then please see this carefully, or if you want me to repeat, I can repeat as well. Okay. The probability of going price up this value will always be positive. Why? Because we have bought a call option. And the call option is exercised only when the price increases. This I've told, I'm speaking this 1,000 times in a class because I want this to enter in your heart, in your mind, that when to exercise a call option, when to exercise a put option, if you're a buyer on that. Okay. So we will be exercising the call option since the price has gone up. 22 into probability of 0.65 plus 0 into 0.35 divided by 1.06. Clear? So 0.65 into 22, other one will be 0, 1.06. So it will be 13.50 or 49 you can write. Okay? $13.490 something is there. So in the exam, let's take it to place decimal. Okay? 13.49. So this value is coming out to be 13.49. Clear? So we have got the point at node B. Node C is already 0. So we can calculate the value of the option at node A on the similar grounds. On the similar grounds. How do we calculate that? Value of the point at node A. Formula will remain same, beta. Okay? The formula will remain same. This value will change only. So going up, the possibility is 13.49, having 65% probability plus 0 probability for decrease in the price, that is 0, divided by 1.06. $8.2721. Okay. So this value comes out to be 8.2721. Or you can write 2 place decimal also. That's not a problem. Just trying to explain you. Is it clear, guys? Any questions? I can wait. I'm waiting for your answers, okay? Your questions before I proceed further. You want to repeat this whole? I can do that. I don't mind. I want your better understanding. Anyone? Okay. Thanks for the confirmation, Sumit. Sumit ji, clear hai? Sumit, Ambika, Chavi. Is it clear, beta? Lakshmi, Siddharth, Raghu, Nanda. Is it clear? Although I know further names as well, but I can't see them. Maybe they are present, I am sure. Pujita, are you guys clear with this concept? If it comes in the exam, can you do that? Thank you so much, Chavi ji, for at least the clear understanding that you have understood. I mean, I'm addressing, although to all the students, those who are watching or those who will be live little later, but this has to be very clear. Okay. So we are starting from the end node and we are coming to the starting node. That is the most, inquisitive understanding of this concept. So in the valuation techniques, we have 3 techniques. First is binomial. We have completed. Risk neutral will be covering after break, and third is Black-Scholes model. Black-Scholes model has already been asked in the number attempt, so you can judge the importance of that. So that can be repeated by the examiner, or binomial can be asked, or nothing can be asked. Again, that is something which is very speculative in the thought process. But you have to make sure that the concept is clear. Okay, guys? Thank you so much, guys, okay. Pujita is present today. It's great to see are all students which I remember their names. Okay, guys, clear? So would you like to take some break before we start with the risk neutral method? Okay. and we'll cover up the question. I think 10 on that, huh? 10 is there, na? Yeah. So 10 is there. The risk neutral method. So those who would be looking at a later stage, maybe, so at least they can save their time by looking at question number 10. Okay, because again, risk neutral can also be explained only and only with the help of a proper question only. You cannot understand from other perspective. Okay, na? So let me share the question with you. Okay, so we are just left with two questions, question number 10 and question number 12. 11 we just covered up. Okay, so I think that will be fine, guys. Clear everything? So those who doesn't need a break can study this question at least for timing. Once we'll come back, we'll cover up these two chapters. Sorry, not chapters, sorry, these two questions, sorry. Okay, thank you guys. Let's break for 5-6 minutes. 5 मिनट्स का ब्रेक डाल दो जय जी. अच्छा अच्छा, हाँ हाँ, क्वेश्चन दिखा रहा हूँ मैं. हाँ ठीक है, आप इसको रखे रखो, यही क्वेश्चन को ही रखे रखो. हाँ, नीचे ऐसे आ सकते हैं. 5 मिनट्स ब्रेक. हाँ बस लिख दो 5 मिनट्स ब्रेक, ये क्वेश्चन आप रखे रहने दो. थैंक यू, थैंक यू, थैंक यू जय जी. Jaiji live? Okay. Thank you. Okay, so welcome back, guys. Thank you for your patience. Now we have to cover up the second method, which is called as your risk neutral method. Risk neutral means that you are trying to neutralize your risk. Okay. So again, that topic is very, very similar as far as that is concerned. The concept is concerned. Only a single change in the formula. Okay. So let me first tell you the formula before you would like to see anything else. Okay, just 1 second. Let me just see the queries. If any, okay, fine. No such issues, so that's great. Okay. So instead of using students, sorry, let me first stop sharing. Otherwise, how would you understand? So instead of using that same formula, we are trying to have a formula like this. Okay. So how the question will proceed? Okay. First, you have to have 2 steps to calculate value of option, which can be called oblique put. Two steps are required. Okay. So since if it will be a call option, so it will be exercised only when the maximum price will exceed from the current market price. Okay. So see the formula very carefully. Maximum price means higher price. Okay. The upper minus market price means spot. Okay. The probability of that, because here also you have to have an upper value and a lower value. Okay. Plus minimum value means the down value minus market price into 1 minus P. The probability of not having the increase in the price means decrease in the prices. Okay? This has to be multiplied. Now it has to be equated with, see very carefully, market price into ERT. Please write this. Okay, clear? RT means the same thing you studied from me, I think first or second class. Okay, R and T. From the question you will have a better understanding. Okay, so first you calculate that, then similarly what you have done it as far as the previous thing is concerned, the value of the call option will be okay, first step, second step. So value of option, okay, call or put anything, will be C UP plus C D 1 minus P. There it was divided by R. You remember the risk-free rate. Here, what will it be? That you need to see. Okay, clear? RT. RT. The exponential value that you've taken, You have to calculate the denominator with that. Okay, guys, clear? Because in the question number 9, they had given you 6% per annum. Here, you need to calculate the E value with RT, means basis on the time. Then you can calculate that. Okay, good to go? Clear? So, using this whole steps, let's study question number 10. I think I gave you in the break time. I'm sure you must have read it. So, any doubts on this? Okay, no doubts. Okay. Should I share it with you again? Maybe, because I'll have to read out. I'll read out quickly. Fatafat say. Okay, not waste time on that. Sure. The current market price is 420 beta. Within a period of 3 months, the maximum and the minimum price is expected to be 500 and 400. Here, the maximum and minimum price is given to you. In case of a binomial model, 10%, 20% was given. 20% upside and 20% downside. If the risk-free rate is 8% per annum, what should be the value of the 3 months call option under the risk-neutral method at a strike price of 450? Given E exponential value as 0.02 as 1.0202. Okay. Sorry, I forgot to write. Sorry. Let me make this thing if it is not clear. Okay. It has to be ERT. ERT. I think I skipped the E word. It has to be ERT. Clear? Can we use this? Same. Okay. So I am using this formula directly to make you understand the concept. Clear? So in this case, the maximum and the minimum price is given to us. The first thing is to calculate the probability, the P value, just like we had calculated in case of question number 9. Okay, can we do that? Can I use this same formula? Okay, sure. Question 10. So calculation of P. So maximum price 500. Market price. What is the market price? Please see 420 given the first line into P that we need to calculate, plus minimum value, the down value which is 400, minus the market price which is 420, 1 minus P, okay, equals to market price, E की value RT. Now how do we get ERT? E, R is 6%, 8%. %8 into 3 by 12. Okay? Means 1/4 value. I think 0.2 something was there. 1/4, 0.2. And this was given to us. Okay? Clear? So I'm repeating this. Maximum price minus the market price. Maximum price is 500. Market price is 420. Multiply by P plus minimum value minus the market price. 400 minus 420, 1 minus P, and 420 E की power RT. Okay? RT. So 0.02. Clear, guys? Okay? It has to be -1, sorry, -1. Okay, -1. So solving this whole, let's do it. It's quite easy. 500 minus 480, 80 P, sorry, plus the value which is there, 20, but it is in negative. Okay, is equals to 420 into it's 1.020 minus 1 karna hai, so we have to reduce the 1 from here, so this will become 0.0202. Clear? And then you will get finally the value of P. So 80p minus 20 plus 20p becomes 100p, multiply by 420 into 0.202. Okay, this will go there, plus 20 divided by 100, I think. So 28.48. P is getting out to be 0.28 something. So 2848. Have I done it correctly? Okay, thank you. Yes. I can repeat step number 1, Ambika, for sure. Thank you, Chavi, for the answer confirmation. The first step is, beta, is nothing. When the risk neutral will come, na, everyone, okay, see everyone. When the risk neutral method will come, this will not give you value 20% up or 20% down. They will give you the exact figure. That's the difference between the two things, two methods. Because risk neutral methods was prepared, by some other person, some John Cox and some Steven, some person. So they said rather than having 20% up and 20% down, they took the actual value and they prepared a model, the formula which says the maximum price means the higher price, the upper price, minus the market price. So you have to identify both in the exam. Multiply the probability of increasing, because this is a positive value, so it is increasing, so it is P. The minimum value minus the market price, 1 minus P is equals to market price into ERT minus 1. It's basically the formula. Study material has provided maybe little at the later stages, but you can write this at least for the examination purpose. The first step for you is to calculate the probability. With that probability, you can use the same formula you used in the question number 9, except the denominator will not be R, it will be ERT. Okay, clear? So how did I calculate that? The maximum price was 500 minus market price was 420, multiply by P, because P is what I have to calculate. Minimum price is 400 minus market price is 420 given to me. 1 minus P equals to 420 ERT minus 1. Whole minus 1. Okay. So this comes to 80P minus 21 minus P equals to 420 into 0.0202. Why? Because the value given to me in the question itself is the value of ERT is 1.020. So if I do the 1 minus from this, it will give me 0.0202. And once I calculate all of them, the value that I'll get, the probability of the increase in the prices will be 28%, almost 29%. The probability of not having that value will be 1 minus the probability. Okay, clear? Is it clear, Ambika? Any other? No. Okay. Students are giving the answers. So thank you. Let me complete this. So I hope everybody is with us till this value 0.2848. Okay. Now we are doing the second step.
It's 9:30.
Okay, this formula is clear, beta. So since it's a call option, we will only take the upper value. We will not exercise this option. Pretty clear? Okay? But in the exam, how do we present? 0.2848, the probability of increase in the prices. Okay? How do you get this upper value? The same way you calculated in the first case, which is the maximum price minus the market price. Plus, iska difference minus 1 means 1 minus P. Okay? Whole divided by this value. Okay? So probability, this is whole, is considered to be C up with the probability of going up in the price. So 0.2848, 500 minus 450, the first step, the value that we took, plus 1 minus P, but the value will be 0 because we will not exercise the call option because the price has gone down. So call options is never exercised when the price goes down. If the examiner asks you a put option, then the first one will be 0. This one will be some value divided by ERT, which is 1.020. Clear, guys? Can somebody calculate this? So 50 into 0.2848 divided by 1.0202. Okay, it is coming out to be 13.958. Okay. Clear, guys? Are we good to go? Any problems? Because here you just need to see in both the methods, the only difference, these two methods are quite simple. I mean, not simple, but similar, I would say rather. The binomial model as well as the risk neutral model. So the only difference is that the formula that they, the interpretation that they use is they use a 20% higher and lower. This is how the node is prepared. Node means a binomial tree is prepared. But as far as the risk neutral is concerned, they give you the exact values in the exam. It means the value could be 500 or it could be a lower value. So accordingly, you first have to see how do you calculate the probability and then you put it in that model. So the steps are same. In that also you first prepared a probability. In this also you first calculate the probability. In second, you use this formula, except you use an exponential value, but in that you use only simple and simple R. So he said, the one who prepared the risk neutral, he said, it will be more prudent if you use this method, which is using an exponential value. Clear, guys? Okay. So 13.96, yeah, 95680. So this confirms that, Ambika, now this is clear to you. I think you were having problem in the first step. Clear, guys? So now can we move on to the last valuation model, which is called as your Black-Scholes model, as far as that is concerned. Yeah, Lakshmi. Just for a clarification, can we say the value option calculating using this method? It is absolutely. Theoretical, this is what I said. This is how you are surrounded with such great students. So she has interpreted that the theoretical value of the call option should be 13.96, which is a constituent of two things. One is intrinsic value and one is extrinsic value. But the examiner will not ask you to calculate this separately. But this is for your understanding that if such situation comes that you are buying the current price is 420, sorry, and you are having a maximum price of 500 and 420, what should be the theoretical value of the option premium? Theoretically, hona kya chahiye? What should be the price? That is what we are calculating, which is the composition of two things. So this we have calculated from the two methods. One is a binomial and one is a risk neutral method. Okay, so this is the two methods which tells you. Third one is little more statistical. Okay, this is more of like a kind of a we can say a guesswork. But the third one, which is Black-Scholes are the one which is more statistical model. So that is the benefit of having such intelligent students, because sometimes even if you're not able to express their thought process, express your teaching styles. So thank you, Lakshmi, for that. So I hope that is clear. And now we can move on to the third point, which is called as your Black-Scholes model. Okay? A lot of queries. Okay, this is okay. Most of them are answers. Okay. Take it. Okay, just one sec. Let's move on to. Okay, so are we good to go for the third method, guys? Okay. So we have little less time. So let's invest that time in solving a question rather than understanding the concept. Okay. So let me share the PPT where I've already given it to you for that understanding purposes. So as rightly said by Lakshmi, the two methods that we have studied is basically nothing but calculating the theoretical price of the option, means option premium. Okay. So basically, the Black-Scholes price is nothing more than the amount option writer would require. Okay, writer means who's a seller, to compensate for writing the call and completely hedging the risk of buying the stock. Okay. So basically, at the end of the day, the only thing is that how much amount of premium he should be compensated as far as the call writer are concerned. What should be the value of the option, whether it's a call option or a put option. But generally we talks about only in the call option in case of Black-Scholes models. Okay. There are certain assumptions which needs to be seen. Okay. In the exam, I must tell you, there is a theoretical question as well. Not recently, little in the past, that what are the assumptions which are used. So you can learn this as well. European option means can be exercised only at the end of the expiry. No transaction cost. Short-term interest rates are known and are constant. Stocks does not pay you any dividend. So there is no additional benefit from the stock. Stock price movements is similar to a random walk theory, like a drunken person. The returns are normally distributed and variance is constant over the life of the options. So there are few certain assumptions that needs to be followed as far as this is concerned. So this is the formula which I have already given to you to calculate the Black-Scholes model. The theoretical price option is composition of two things. One is S ND1 minus XERT ND2. Okay, so the formula for D1, I've already given it to you. The formula for D2, I've already given it to you. So first you will calculate D1. Okay, then you'll calculate D2, then you'll calculate ND1, and then you'll calculate ND2. What is D1? What is ND2? I will explain you over here first. Okay, then followed by the question which will complete this concept. Okay, should I close this? See now carefully. The third one, Black-Scholes model. So the theoretical price, okay, the theoretical option price, what stated correctly by Lakshmi is, this is equals to, you have to first calculate the SND1. Okay, this is calculated using a table. I will show you everything today. Everything. I have everything in my PPT. So you don't be, worried about anything. Just focus on the concept. Okay. What is this S? This is basically your market price. Or you can say the current stock price. Okay? Stock price. Okay? Minus X, because we are using those terminology which was given by this person who has prepared this. X is your exercise price, oblique the strike price. So again, in the exam, you have to identify this. Simple. E minus RT, we are just using the risk neutral method. RT means the time remaining to expiry and multiply by the risk-free rate. So you have to compound that according to that. And multiply by ND2. This also you calculate from the table. Table I'll show you. Screen pay I'll show you. So don't need to worry. This is an exponential value. Okay. So this is given to us in the exam. This is given to us in the exam. The values we can calculate in the exam, just like we have done it in the risk neutral. The only point is that calculating D1 and D2 and unka n values lena. N values ko matlab hai means you have to take their normal cumulative distribution values. So how do you calculate D1? So if D1 is calculated, D2 can be calculated easily. So what is the formula to calculate D1? It is logarithm of, you have to take the logarithm of S by X stock price divided by your exercise price plus, now little technical, R we've just spoken, that is your risk-free rate compounded. Now there's a new term of volatility plus volatility ka square divided by 2 multiplied by T whole divided by V under root of T. Yeah. Sometimes even I forget, being a teacher, so I can understand the situation of the students. Okay. Just sharing you a very simple thing, nothing related to making any speculative statement. I was preparing for my ACCA exam. I'm already qualified ACCA. So in those exams, this formula is given in the question paper itself. So they just ask you that you apply. But in your CA curriculum, you will have to learn this formula. So in the exam, you will not get this formula. So they used to give the formula on the question paper itself. So they say that apply this formula, and they also used to give the ND1 and D2 values. So that was simple. But in this, your CA exam, you have to learn this. Okay. D2, if you get D1 becomes D2 simple, D1 minus this numerator, denominator, V underscore of T. Clear? I mean, formula obviously, unless you don't apply it, you will not able to follow it. So can we end the session with the last question of the day, which is question number 12, so that we can understand the Black-Scholes model. After once you do this, please solve the November 20 question paper, because I think Black-Scholes was asked. Somebody told me. I've not seen the paper yet, but somebody told me. So can you see that? The formula, any doubts in the formula? Obviously, why would you have a doubt? So if you have a doubt in the formula, you have to meet the person who invented this formula. It wasn't me. So you really can't, say anything on that. Okay, clear? Chalo.
It's 9:45.
Last question for the day. 15 minutes approximately remaining, and we will try to complete this. Okay. The last chapter from my side in this calendar year. Okay. Can I rub this? And we will use it practically. Okay. So let's see what all values are given. Is the S value given to us? Yes. Which is 185. Is the option exercise price given? Yes. X is given, which is 170. R is given to us as 7%. And time to expiry is 3 years. The standard deviation for calculating D1 is 0.18. Calculate the value of the option using the Black-Scholes formula. Okay? So table level, everything I'll show you. The value that you get. Okay. After you calculate the D1 value, you have to use the normal cumulative table to get that ND1 and ND2 values. Okay. Should we do it? Chalo, let's start doing it. I think we can use at least the first formula, the D1 wala formula. Hai na? No, space is little less. So I'm rubbing this. I will use this formula. Okay, na? So question number 12. Okay. Calculation of D1. Okay. So log of S divided by X. Okay. 185 divided by 170 plus R की value 7%, 0.07 plus standard deviation means volatility. Okay, divide by 2, multiply by T. So T is in year form, which is 3 years. Okay, divided by this standard deviation. Okay, V means standard deviation 0.18 under root of T, which is 3. Okay, I hope this thing is clear. Now this complex things might seem to little easier for you now. Might be I'm saying. Okay, clear? So how you will get this value? You have to calculate the log of this. So log I don't have in my calculator, but I can use it at least in my mobile phone, because we have a log. When you invert that in the exam, you will get the log table. Okay. So 185 divided by 170. So you have to calculate the log of 1.088. So that is equals to log of 1.088. Okay. Plus all this big calculations. 0.8 divided by 2 plus 0.07. 0.0 thing into 3. 2586 into 3, 2586 divided by 3 ka under root into 0.18. 0.3117. Please check if I'm wrong it somewhere. 3117. Okay, log of 1.088. Okay, sorry, mobile. So my log is coming out to be, in the exam you will get the log table, 0.084. Okay. 0.84, okay. And this divided by 3117. 3117. Okay. I'm getting the value as 1.1006. Okay. Everybody has got this value or not? Please confirm me. This is standard deviation. Sumit, this is standard deviation. Okay, beta? Standard deviation. So thank you, Nanda Usha. The confirmation is this is correct. 1.10, that is the D1 value. Okay. So Nanda, can you calculate the D2 as well? So D2 is equals to 1.106 minus same, the denominator, okay, 0.3117. 7889. So our next step is, I'm removing the formula. So this is just a normal calculation. Then you have to calculate the values which is ND1 and ND2 from the tables. So should I show you a table? How we will get it in the exam and how to calculate that? A lot of students make a mistake. One thing, before we proceed further, a lot of students make a mistake in taking the wrong table, because as Chavi and Nanda has said that this value is coming out to be positive, it can come at negative also. I mean, they are right. I know they are right, but in the exam you might get some values in which the D1 can come out to be negative. What's the big deal on that? Maybe because here that the thing is positive, so you are getting a positive value, you can get a negative value as well. So which table that needs to be seen is, let me show you to you for your kind references. See this table, aram se. So in the exam you will have either two values. You have to calculate the value of nx, means nd1 when the x is less than 0. So you can see all these values are coming out to be negative. And this is nx1 when the values are positive, equals to 0. All these values are coming out to be positive. So what is our value? Is it positive or negative? What our dear student have just stated? Nanda and Chavi, 7.489 and 1.06. So we have to take this table, right hand side wala table. Okay, clear? So should we identify this value? 1.10, 1.1006. Can you see that? And 0.78. Sorry if the font is too small. You can see it from your tables at home. Okay. Even if the font was small, I'm sorry, you can see the bigger one value from here. So ND1 is coming out to be 0.8770 and ND2 is coming out to be 7823. Okay? Should I stop sharing? Okay, no worries. I have one more thing for you, because I thought if it will not be clear, I can show you the next table. Okay, here you can see maybe a little bigger one. This is positive value. This is right hand side is positive. This is negative. So 1.106, 1.106. Okay, somewhere over here. Okay, 0.85 some values. Okay, sorry, not this one. Sorry. This value, 8643 something. Okay. So now can we complete this table? Okay. So it might vary somewhere. Okay, little bit. Okay, just in case. And these two values. So we just have to put it in the main formula and you will get that value. Okay. So what was the formula, students? if you remember that, value of option, okay, it started with I think S and D1, okay, minus X ERT, if you remember, okay, ND2. Okay, these two values we have, we just have to post it in this, oh, sorry, minus RT, sorry, minus RT, minus RT. Okay, just have to post these values and you will get your answer. Okay, so what was the S 185 multiplied by ND1 is 0.8770. You can have a little different value because we are looking from table, but it will be very closer to that. Okay, minus X will be 170 into since it is minus RT, so I can also write this as divided by ERT, which is R is 7 and that is 3 years. Okay, 7. 21 is the value, okay, 0.21. So since the value is minus RT, you can write it as E 0.21. Okay, you will get this value in the exam, and ND2 7823. Okay, so please make sure in the exam you have these points, decimal very correctly. Otherwise, your whole answer will be incorrect and you will lose your precious marks. Okay? Now, just a very simple thing. Has this value given? Okay, E's value is not given. So E value is not given. Let me use my mobile to get the exponential value. E 0.21. It will come out to be 2336. Okay, but in the exam you will get this value. Might be I might have forgotten in the assignment, but you will get that. Clear, guys? So can you calculate these values? So Chavi is saying 54.435. OP. Okay, others can check. You might have 1 or 2 rupees difference. That's not the problem. We should appreciate Chavi's effort to provide us the value at least. It might differ 1 or 2 rupees. That's not a problem. Okay, so that ends basically our concepts well on time. Okay, that completes our concepts at exactly 10 o'clock almost now. Okay, 30 seconds to go. So that ends our session, guys. So it was a really nice session with you. Just to give you an update, I will not be present with you going forward, at least in this calendar year. I'm just going for some breaks because I think my period has been a little long. You might have got bored with me. I'm associated with you since 26th of October. So today is 22nd December. So 2 months I've been with you. I don't know how you liked the concept of teaching. We will get in touch definitely post the calendar year, the new year. The year had not been very good for our entire world because of the crisis that we have faced. But again, we have seen the pros and cons of the things. We are still together because of technology. The businesses were shut down, but at least we guys were in touch because of this technology that we have reached. If such situation would have happened 50 years or 60 years back, then I don't know how we would manage. So that could be the thing. So it was really great time. Next topic, Forex, will be taken up by another very experienced teacher. Okay. I hope you will have a great time with sir. And I will see you post Forex. But still, even if you have any doubts, you can always contact me. I'm not at all tough to address. Even if you have any queries, you can post it on the chat box now or later on the YouTube channel. That's not a problem. I hope and I sincerely pray that the year which has gone now, 2020, might not have been very good for a lot of people, a lot of problems, a lot of diseases, a lot of, lockdowns had happened. I hope 21 year remains good. I wish you all the best for your CA preparation. Maybe I'll see you after the Forex chapter, which is International Financial Management. But again, all depends upon the VOS. Okay. So all the best for your Forex classes. I hope you have understood these 4 classes that you've taken on the derivatives, about 12 hours. You can imagine 12 hours is a big time. Again, this chapter is, you need to spend about 20-25 hours more on that to have a better, more understanding. But again, I end this session today as your friend, as your mentor, with best wishes to you and your entire family. A very, very, prosperous Christmas and a prosperous Happy New Year to your entire family. Thank you, Board of Studies, from Chairman Sir to the last person in the entire team, plus the IT team, which helped us to make you connect with each other. Thanks a lot. Big thank you for everyone. Okay. Bye-bye. Take care.